Algonquin Power and Utility was a must-have stock in the Canadian portfolio, but has this changed? Holy banana bread, let's do this. One of the first stocks I had invested in was Algonquin Power and Utilities for a nice dividend and some steady growth. This story has changed as the economy has veered towards a recession. The dividend yield has grown while the growth has moved in the opposite direction. This has left many people asking, what the heck is going on with AQN? Before we charge up an answer, tell me in the comments if you are currently holding AQN. I am always grateful when you drop in on my home of free financial content on YouTube. While you are here, please subscribe as you don't want to miss a single moment. And a huge thank you for that click. Algonquin Power began as a power income fund back in 1997, but by 2009, they became a corporation in response to tax changes made by the government that was not so favorable for income trusts. They are a renewable energy as well as a regulated utility company that operates under their own name, as well as Liberty Utilities, Liberty Power, and the Bermuda Electric Light Company. I wonder if any ships have got lost in that one. They do operate in Canada and the United States, and roughly 75% of their utility revenue comes from the United States, and this may be a contribution to some of the problems they are currently having. Let's jump in right away to the math, because I think we can expand on some of the issues as we stroll through those numbers. As usual, we will begin with their market cap, which is currently coming in at $6.752 billion, making them a mid-cap company. Back in April of 2022, they actually had a market cap of $13.53 billion. So it is easy to see that we have a problem here. Their beta comes in at 0.35, so they are not volatile, well, at all, which is exactly what you would expect in a 70% regulated company. In fact, normally a company with this much regulation does well in tougher economic climates. Their earnings per share come in at 0.05, and they have no significant dilution. Their earnings are forecast, however, to grow by 66.97% each year, which is absolutely needed for AQN. They have a price to earnings ratio of 199.80, obviously due to their earnings being so low. This is another case where it is just better to use their price to sales ratio, which comes in at 1.90. The price to sales average for similar companies is also 1.90, so they are right in the middle of the pack, sitting on the average line. Their price to book ratio comes in at 0.79, which means they are valued 79% of their book value. This makes me think the company as a whole is going to be undervalued. If we look at their fair value via a discounted cash flow model, it comes in at $23.90. They are currently priced at $9.91, so they are underpriced by 58.5%. Holy banana bread. This could be an opportunity, and we will see why in just a moment. Their dividend yield is greatly inflated due to that very depressed share price, and as a result, it is coming in at 9.55%. That is paid out quarterly in the amount of 18.1 cents USD per share. This is not too shabby. Normally, it is almost half this, and if you have confidence in AQN's future, then this is, well, maybe a steal. However, if we look at their payout ratio, it is coming in at 1,004%. These dividends are absolutely under no circumstances well covered by their earnings. Their dividend has been growing for the last 10 years, but that is no guarantee that that will continue. We need, of course, to look at their growth or lack of growth. At the start of 2021, AQN was listed at $21.90, and by the end of the year was at $18.51 for a return of investment of negative 15.48%. Factoring in their dividend, we are looking at a total return in 2021 of negative 11.65%. Holy banana bread, where is the boom? At this point, it gets really bad. As we enter the bear market in 2022, their stock fell all the way down to $9.91 for an ROI of negative 46.46%. Another holy banana bread. That is not good at all. Even if we add the dividends, you're still down 42.71%. With the energy boom, you would be rightfully just to be like, how did they miss that wave? A good part of that is their heavy diversification into the United States. As the U.S. began to feel the pain of their unofficial recession, so did AQN. Their drop was then supersized by the fall collapse of oil. Between these two events, we had the perfect storm for AQN's dive. Before we can sort this out any further, though, we do need to also look at their debt. Algonquin has a total debt of $7.765 billion. They also have $7.062 billion in equity. That means that their debt to equity ratio comes in at 110%, which is actually not as bad as I had been fearing it might be. We need, of course, to dig in a little bit deeper. In the short term, they have $1.07 billion in short-term assets compared to $1.49 billion in short-term liabilities. When we switch over to the long term, their long-term assets are $16.59 billion compared to $9.10 billion in their long-term liabilities. These are not great numbers. They are unable to cover their liabilities short term, which is not a position I like to see. Long-term things, of course, yes, they do look a little better, but still overall, it's a mess in the here and now. One shining light in all the debt mess is that their debt to equity ratio has decreased over the last 5 years, dropping from 125% to 110%. The big concern is that with a bad debt picture, it is only going to be made worse by rising rates, which we are seeing now and will continue to see in 2023. Their debt and the interest on their debt is not covered by earnings, and that is a major concern. Due to the power of cuts, the kitty has joined me for the last little bit here as we take a look and see what is the final verdict. Algonquin was once a favorite, and even though it has lost most of its shine, I still want to see them soar once again. Their debt is concerning, and they are going to feel a lot of pain as a result. Will they cut that dividend? I don't think they want to, and I think they will try whatever they can to maintain it. However, it may make sense to cut it. They are looking at asset recycling, which involves recycling invested funds in older assets to pay for new assets as a way to generate revenue and, well, to avoid more debt. In AQN's case, we are looking at a partial sale of the 3 wind facility to help fund the purchase of Kentucky Power. This would increase their overall regulated utility share, and that, of course, well, we've already mentioned, will bring more stability to the company overall. With moves like that, there is hope that AQN could have a much better future. There is a risk in investing in them now as this struggle pays out, but sometimes fortune does favor the bold. If you are only in the game for the dividends, then now is the time to grab them and maybe keep your eye on the ball, just in case they get to that point where they do have to cut those dividends big time. I think the odds are that they will do whatever they can to avoid that. Of course, the decision is always yours. Just do your due diligence before you put your money on the line. The fun does not have to end here. Check out my video on Intel that I will link on the left. Otherwise, check out the video on the right that YouTube thinks you will like. Your click will decide who is right, and I will see you in the next video.